Welcome to this video. Let's continue our conversation to learn about the basics of the stock market. If you guys don't know me, my name is Austin, and in this channel we talk about personal finance, investment, and lifestyle. So we're doing this series on the stock market where I go through from the basic concepts to more advanced topics. Last time we talked about what is a stock, why do people want to buy stocks, and why do companies want to sell their stocks. Today, let's continue the conversation by jumping right into what is a market. Of course, I am talking about a stock market, but I always like analogies and it always helps me to learn. So let's talk about a market that we're all familiar with, which is a grocery store. Imagine in a grocery store, there will be sellers and there will be buyers. And the price of goods are always set to a fixed price. So for example, the bread is always going to be around $1 or something like that. However, like in most places, there is no such a thing as bargaining in grocery stores. But the stock market is different. In the stock market, the buyers can actually compete on the bid that they're willing to offer, and the sellers can compete on the stock price that they're willing to trade it for. So for example, if you're going to a grocery store, imagine this. Instead of a fixed price of bread that's set at $2, you may see sellers that's yelling, hey, I'm selling my bread for $1.95, and other people are talking about, I'm going to sell my bread at $1.90. And if you're a buyer, you may be offering $1.25, you might be offering $1.50. Whatever it is, this of course wouldn't work in most grocery stores. Imagine how hectic that would be, right? However, this is how the stock market works, where the buyers actually bid for the best price that they're willing to purchase it at, and the sellers are also bidding for the price they're willing to sell it for. And this is all going on simultaneously, which is why you see the fluctuation of the stock prices as you look at those charts. To buy stocks, there are two main different markets. Number one is the primary market, and the second one is the secondary market. Primary market is where the stocks are traded for the very first time, and every subsequent trade is going to be on the secondary market. So most of the time, the public, of course, is purchasing through the secondary market, and I'll talk about what the primary market looks like. So let's go back to that example in my previous video talking about the clothing store, right? Imagine you're the owner of this clothing store, it's doing really well, and you had some private investors. Now you want to go public. You want an even bigger portion of the pie so you can expand further. So how are you going to go public? In this case, every company has to go through this process called IPO, which means initial public offering, where together with the private investors, you might sell a portion of the shares to the public. To go through an IPO, you usually use an underwriting company where they are expert in pricing the price of the shares at the moment that it goes public. They are also in the best interest to make sure that the price they set meets the price that is generally going to be accepted. Of course, if it's too high, that means during the IPO it would fail, and they would also get a bad reputation. So let's say after looking at the earnings report, looking at the debt, the product portfolio, etc., your underwriting company decides that they can raise $10 million for 1 million shares priced at $10 per share for your closing company. All right. So the underwriting company then would call and contact all the brokers and banks that they know, and they'll try to sell the share to the big clients. It's usually only sold to big clients, even at IPO. Hence, it is rarely possible for the general public to get into the primary market and purchase at the IPO price. Then at a later stage, once the stocks are traded at the exchanges, if you're the general public, then you will be buying it from public exchanges such as New York Stock Exchange or Nasdaq, etc., which you may have heard of. So most people are not going to be able to purchase from the primary market, and that's why most people, when they're talking about buying a stock, they are talking about the secondary market. Okay, so next let's talk about what is a stock exchange. So what is the difference between a stock exchange and a market? Imagine a stock exchange is the actual grocery store, such as Whole Food or Walmart, whereas the stock market is just the general term, such as a grocery store, right? So when we're talking about the stock exchanges, we're talking about the actual place where the stocks are being traded. And there are three main exchanges currently for the American stocks, which is the New York Stock Exchange, as well as the Nasdaq, and lastly, the Amex. New York Stock Exchange is one of the biggest, and it is also the most demanding exchange to be listed. It looks into the company size, looks into the number of employees, the price of the stock, how liquid is the stock, as well as how many times it has been traded a day. For the Nasdaq, it is less demanding, and it is known for having a lot of tech stocks that's traded in Nasdaq. Most of the time, one company is only going to be listed in one exchange and not multiple exchanges. Amex is catered towards ETFs mostly. I do have a video which talks about what is an ETF, so feel free to check it out over there. Okay, so now we talked about the market, we talked about the actual exchange. Let's talk about how do you buy stocks, right? Who do you buy it from?
You finally found a broker on Wall Street that you can trust and who can consistently make you money. Sound fair enough?
No. Traded stocks before, you would know that you have to buy from a broker. Broker is someone that you have to go through to buy the stock, and you have to contact the broker, which the broker will actually contact another broker, and then through that they'll get the client who is willing to see if they want to purchase or sell the stock that you're willing to either buy or sell from, right? Historically, you had to contact a broker through mail, and then it came to telephone, makes the things much easier. As they got more busy, the actual brokers actually hired floor brokers. So you have seen movies, you may have seen where these floor brokers will be literally on the stock exchange floors, yelling on the top of their lungs like, I want to buy 100 shares of this and this, priced at $100, $101, etc. Nowadays, it's very automated, where you can actually enter the orders just very easily online through a computer, and it'll be transmitted to the exchanges. So with time, broker no longer has to be on the floor anymore, and the connection between the buyer and seller can now be done automatically. All right, so that concludes the video, and it concludes the very first section about the very basics for the stocks. Next, I'm going to talk about orders, and eventually we'll get into more complicated concepts such as technical analysis. So stay tuned. And again, if you enjoy the videos, please remember to like and subscribe. Please support the channel. Thank you very much. Until next time.